Imagine a hardware company. It earns 55 cents of net profit on every dollar of revenue. Its return on equity is over 100%. It carries almost no debt, less than $11 billion against $62 billion in cash. And if you adjust its price-to-earnings ratio for its growth rate, it looks cheaper than most boring industrial stocks. Now, does that sound like an overvalued company to you? That company is NVIDIA. And the most common thing you'll hear about NVIDIA is that it's priced for perfection, that it's gotten ahead of itself, that the valuation is stretched. The numbers say something different. Let's look at what they actually say. Fiscal year 2026 ended in January. Revenue, $215.9 billion. That's up 65% from the year before. 1 year, 65%. The engine driving that number is the data center segment. AI chips, AI systems, the infrastructure that every major cloud provider and AI lab is racing to build out. That segment alone generated $193.7 billion, roughly 90% of total revenue. It grew 68% year over year. Now here's what makes this unusual. Gross margin came in at 71.1%. That's a software company margin inside a hardware business. The conventional assumption is that hardware is a low-margin, capital-intensive grind. NVIDIA has structurally broken that assumption. Net margin was 55.6%, meaning for every dollar that came in the door, more than half stayed as profit. The balance sheet reinforces this. $62.6 billion in cash, $11 billion in total debt, working capital of $93 billion. This is not a company running on leverage and financial engineering. It's a company that generates so much cash it doesn't need to. Operating cash flow in fiscal year 2026, $102.7 billion. Free cash flow, after capital expenditures, $96.7 billion. NVIDIA used a significant portion of that to buy back over $40 billion of its own stock. Not with borrowed money, with cash it generated from selling chips. When was the last time you saw a hardware company with numbers like that? Genuinely, name one in the comments. I'll wait. Strong numbers don't sustain themselves. Something has to protect them. In NVIDIA's case, that something is CUDA. And most people who talk about NVIDIA's moat underestimate what CUDA actually is. CUDA is not a feature. It's not even just a software platform. It is 10+ years of accumulated developer tooling, academic research, enterprise integration, and institutional muscle memory. When an AI researcher writes code, they write it for CUDA. When a data center engineer optimizes a training run, they optimize it for CUDA. The entire modern AI software stack was built on top of it. That matters because it means the competition isn't just building a better chip. They're trying to convince an entire ecosystem to rebuild itself from scratch on a new foundation. AMD's MI300 is a serious piece of hardware. Google's TPUs are impressive for specific workloads. Amazon's Trainium is real. None of them have meaningfully dented NVIDIA's 80 to 85% market share in AI GPUs. The 5-year revenue CAGR is 67%. EPS has compounded at somewhere between 90 and 98% annually over the same period. Those are not the numbers of a company that's about to be disrupted tomorrow. Institutional holders understand this. Vanguard holds roughly 9.3% of the company. BlackRock holds 8%. These are not momentum traders. They're not chasing a trend. They're making long-duration bets on a structural position that they believe will hold. That said, moats are not permanent. The honest version of this analysis has to include that. The question isn't whether NVIDIA's moat is real. It clearly is. The question is how long it holds and what would have to be true for it to erode faster than expected. That question is where the risk analysis actually lives. There are risks worth taking seriously, and there are risks that get more airtime than they deserve. The distinction matters. The risks that deserve genuine weight. First, geopolitics. Approximately 31% of NVIDIA's international revenue is under pressure from U.S. export restrictions on advanced chips to China. That's not a minor regulatory nuisance. That's a material constraint on a significant revenue stream. And the deeper vulnerability is TSMC. Almost everything NVIDIA sells gets manufactured in Taiwan. A serious disruption to TSMC's operations, whether from geopolitical escalation, natural disaster, or supply chain fracture, would hit NVIDIA harder than almost any other large-cap name in the market. You can't hedge that risk away entirely. You can only price it. Second, customer concentration. The top 4 customers represent roughly 61% of revenue. The top 2 alone account for 36%. When you are that dependent on that few buyers, your business is partly a function of decisions made in boardrooms you don't control. If Microsoft, Google, Amazon, or Meta decides to slow AI capex in any given quarter, you feel it immediately. The diversity of the revenue base does not match the strength of the income statement. Now, the risks that get more attention than they warrant. AMD's competitive progress is real but slow relative to the switching costs embedded in CUDA. Short interest is sitting at about 1%. The macro environment, with the yield curve positive and PCE moderating toward 2.5 to 2.8%, is not a headwind. Near-term volatility in the stock doesn't reflect anything broken in the business. Which of these risks do you think gets the least attention in mainstream NVIDIA coverage? The geopolitical concentration or the customer concentration? I'd argue it's the customer concentration. It's less dramatic than Taiwan, but it's more directly tied to near-term earnings risk. Think about it. So the question the hook raised, is the stock actually expensive? Trailing PE is approximately 37. In isolation, that sounds high. In context, it's less obvious. A company compounding earnings at 90% annually is not comparable to a utility or a bank trading at the same multiple. The multiple has to be understood relative to the growth. The more useful number is the PEG ratio, 0.4 to 0.58. PEG divides the PE by the earnings growth rate. A ratio below 1.0 conventionally suggests the stock is undervalued relative to its growth. Below 0.6 is unusual. What it means practically is that the market is pricing in a very significant slowdown from current growth rates. The stock is not priced for growth to continue at anything close to its recent pace. It's priced for a meaningful deceleration. That's either prudent or pessimistic. The answer depends on what you believe about the AI investment cycle. Run a DCF. Use the $96.7 billion in free cash flow as the base. Taper growth from 45% down to 20% over 5 years, a conservative assumption given the current trajectory. Apply a WACC of 10.5% and a 5% terminal growth rate. You get an intrinsic value of approximately $212 per share. Against a current price of roughly $183, that's about 16% upside on a conservative model. If you assume growth closer to 25 to 30%, the stock looks roughly fairly priced. If you use the consensus analyst target of $274, the average across 53 analysts, with 51 of them at buy or strong buy, you're looking at implied upside closer to 50%. The stock is not cheap in absolute terms. It is reasonably valued to modestly cheap relative to its growth, and expensive only if that growth slows sharply. The bear case for valuation requires a specific set of conditions to materialize. It's not the base case, but it exists. 3 ways this plays out. Base case: the AI infrastructure cycle continues. Hyperscalers, Microsoft, Google, Amazon, Meta, keep spending at current or increasing rates. The Blackwell platform executes as planned. The Rubin platform, expected in the second half of fiscal year 2027, extends the product cycle before any meaningful competitive response emerges. Revenue compounds above 30% annually. The stock follows earnings higher, likely with multiple compression that gets partially offset by growth. This is where the majority of analyst probability weighting sits. Bull case. NVIDIA successfully moves beyond data centers. Robotics, autonomous systems, and sovereign AI. The wave of national AI infrastructure programs being built out by governments globally add entirely new revenue streams on top of the core business. Customer concentration decreases as the addressable market widens. The CUDA moat deepens with each new application domain. In this scenario, the $400 price targets that look aggressive today start to look conservative. Bear case. Hyperscaler capex cycles turn. It doesn't take a collapse, just a pause. If the major cloud providers decide they've built enough capacity for the next 12 to 18 months and pull back on orders, NVIDIA's revenue growth slows sharply. Simultaneously, custom ASICs from Google and Amazon eat into workloads that previously ran on NVIDIA hardware. Export restrictions tighten further. The multiple compresses. The stock falls 30 to 40%, not because the business breaks, but because the premium the market was paying for sustained hypergrowth no longer feels justified. The base and bull cases represent the most plausible outcomes given current data, but the bear case is not a tail risk. It's a scenario with real preconditions that are worth monitoring. If you own NVIDIA, the number you should be watching is hyperscaler capex guidance, every quarter in every earnings call from Microsoft, Google, Amazon, and Meta. That's your leading indicator. Which scenario do you find most plausible right now? Not as a prediction, as a conditional judgment. What would have to be true for the bear case to materialize this year versus next? Work through it. The answer tells you something about how you're actually pricing the risk. Here's the thing to hold on to. NVIDIA is not really a bet on a company. The margins, the moat, the balance sheet, those are already visible. They're already in the price to a significant degree. What you're actually betting on when you buy NVIDIA at current levels is the pace and durability of the AI infrastructure build-out. You're betting that the company spending hundreds of billions to build AI capability will keep spending. That the demand for compute doesn't plateau before the next product cycle compounds the lead further. That's the actual decision. Everything else is context for making it more clearly. This video is for educational purposes only and does not constitute financial advice. All investment decisions carry risk. Do your own research, understand your own risk tolerance, and make your own conclusions.